I will show you 5 rules. If you follow, you will pay 0 interest on your credit card. This is Naida from Insight Experts. Now here is the 5 rules. If you follow, you will pay 0 interest on your credit card. Rule number 1. Never spend more than you earn. The number 1 reason people get quickly into credit card debt is because they spend more than they earn. It's very simple. If you cannot earn it tomorrow, don't spend it today. The problem is, people normally fall into the trap of using their credit card for purchases they do not plan to make anyway, and to rack up points for travel, gifts, or cashback, eventually building up debt higher than their monthly income to the point where the debt-ending cycle will never end, even when making regular monthly repayment on their credit card. Keep in mind, how much you spend must be relative to how much you earn. Rule number 2. Never miss a payment and never pay the minimum. If you are someone who pays their credit card on time but usually less than their monthly closing balance, you will then be carrying the remaining amount plus the accumulated interest over time. Let me show you an example. Let's say your credit card opening balance in January 2021 is $4,000 and your due monthly minimum repayment is 2% of that amount, which is $80. Now, if your credit card annual percentage rate is 20.24% on an average, you will also be charged a monthly interest of $65.21 on the balance, which makes your actual repayment for January only $14.79 and the closing balance at $3,985.21. Now, if you continue making just the minimum due repayment every month of 2% of your closing balance, you will finish the year repaying in total $941, while the accrued interest will be $767, making your net repayment of only $174. Now remember, you've started the year with a debt of $4,000 and finished owing $3,826.10, $174 less, despite repaying $941. That is because the interest charge has been catching up with your repayment. Now, if you continue making the minimum repayment every month for the next 5 years, it will not make a dent in your debt, and the accumulated interest will have a heavy toll on you. Now, with an opening balance of $4,000 beginning of Jan 2021, after 5 years, you paid back in total $4,312, more than your opening balance, yet you still owe the bank $3,202.90. That is because the interest charge was rapidly accumulating and offsetting your repayment and rendering your total net repayment after 5 years of only $797.10. In our example, we assume no new purchases were being made throughout the 5 years, but simply minimum repayments on existing credit card debt. Otherwise, your debt would have been much deeper had you made new purchases throughout the 5 years. This is because a lot of people are not aware that if you just make the minimum repayment on your credit card rather than paying the closing balance, you will be disqualified from the interest-free period and will be charged interest on your unpaid balance from after the due date until you repay in full. As a result, most credit card users struggle over time to pay off their debt, making them the most profitable people to the bank. On the other hand, if you pay your monthly credit card balance in full by the due date, you will never pay any interest and the bank will be making little money of you. Well, you might argue, how can it be possible to pay off the closing balance by the due date if I don't have the full amount? My answer is, go back to rule number 1, never spend more than you earn. So remember, never miss a payment and never pay the minimum. An additional benefit beside interest saving will start to pop up, such as the banks waiving your annual credit card fees and the prospect of offering you loans with easy lending criteria. Rule number 3. Choose a credit card with the maximum number of interest-free days. Let's be realistic. It may not be possible to pay your credit card in full by the due date unless you have more than 1 month of income, so securing more time is critical. Therefore, follow the longest road to payment due date to give yourself the maximum possible time to plan, prepare, and secure end of month's full payment. Let's look at this example. For a 30-day billing cycle with purchases made within a 55 days interest-free credit card gives you 30 days of interest-free and another 25 days grace period before the due date. So, the higher the interest-free days, the better. Now, 55 days is normally the highest interest-free days banks would offer. However, look around as there are few providers with credit card offering interest-free periods of more than 55 days. Rule number 4. Gradually reduce your debt liability as you approach the end of the month. Now, if you are a few days from the end of your billing cycle, avoid making large purchases since the payment due date is closing in. Instead, throughout the month, follow a high to low purchasing strategy, making larger purchases beginning of the billing cycle and gradually moving to smaller ones towards the end, and therefore easing the pressure on your commitment as payment due date is closing in. So let's say, for example, your credit card 31-day billing cycle starts May the 1st and ends May the 31st and comes with a 55 days interest free. The way to go is to follow a high to low purchasing strategy, making larger purchases beginning of the billing cycle where the number of interest-free days is high, and gradually moving to smaller ones towards the end of the cycle where the number of interest-free days is low. The strategy eases the pressure on your commitment as payment due date is closing in. Now, what if an unexpected large purchase popped up somewhere in the end of the cycle? Well, if it is urgent, then you have no choice but to transact and pay off in 25 days. But if you can just wait few days and defer it to the start of the next cycle, cycle 2, you will then have 55 days of interest free, a long way before payment due date. Rule number 5. Win yourself extra time before payment due date. We said it before, it may not be easy to pay the full statement amount by the due date unless you have more than 1 month of income. So on top of the conventional 55 days interest free, you can even stretch it further by another 15 days. For this to work, you will need 2 credit cards from 2 different banks. So let's say now your credit card 1 has a 30-day billing cycle and a 55 days interest free. The cycle starts March the 1st and ends March the 30th. If you make a purchase on the first day of the cycle, you will obviously have 55 days of interest free till payment due date April the 25th. If you make another purchase, say on March the 7th, the interest free day is now being reduced and you will only have 48 days till payment due date April the 25th. Now we will continue using your credit card as you would normally do till you get precisely to the middle of the cycle, March 15th, whereby then the interest free days is being reduced to 40 days till the payment due date April the 25th. Now if you have credit card 2 whose billing cycle overlaps that of credit card 1 by 15 days and therefore start March the 15th and ends April the 15th. If you switch March 15 purchase from credit card 1 to credit card 2, you will then have 55 days of interest free instead of 40 days, therefore gaining you an additional 15 days. Now you will continue using credit card 2 for all your purchases, but once again, once you get to the middle of the cycle, you switch your purchases back to credit card 1, therefore gaining you an additional 15 days of interest free. Now let's do a recap. For this to work, you will need 2 credit cards from 2 different banks. You may have to split the credit card limit between the 2 cards to secure the approval from the bank. Now, the billing cycle of one card must overlap the other one by exactly 15 days. So if you already have 2 credit cards, ask your bank to reinstate the billing cycle of either card so that the overlap is exactly 15 days. Remember the billing cycle start and end of both cards. This is very important to switch purchases at the right time. And lastly, you have to be disciplined. And remember, more cards does not mean more spending. So here is a summary of the 5 rules. If you follow, you will pay 0 interest on your credit card. Rule number 1, never spend more than you earn. If you cannot earn it tomorrow, don't spend it today. And rule number 2, never miss a payment and never pay the minimum. Pay your monthly credit card balance in full by the due date and you'll never pay any interest. Rule number 3, choose a credit card with the maximum number of interest-free days to give yourself the maximum possible time to plan, prepare and secure end-of-month full payments. Rule number 4, follow a high to low purchasing strategy, making larger purchases beginning of the billing cycle and gradually moving to smaller ones towards the end of the cycle, and therefore easing the pressure on your commitment as payment due date is closing in. And rule number 5, stretch the interest-free days beyond what is allowed. More days means more times and more planning. You can gain an additional 15 days of interest-free by using 2 different credit cards and switching purchases in between every 15 days. Coming up next, are you struggling with a large credit card debt? I will show you a simple and easy way on how to clear your credit card debt and save thousands of dollars. To stay up to date, make sure you like, share and subscribe. This is Nader from Insight Experts and thanks for watching.